Hi there, Evan here with Crypto and Markets for Friday, October 12th, 2018. What I'm going to cover today is how we got here in the Canadian real estate market, where we stand now, where we're going in the future. Firstly, as I mentioned in previous videos, and has really been the basis for this whole thing, the Bank of Canada, remember, did 2 rate cuts in 2015, which were intended to save the oil market, take care of the oil lobby. But of course, they had the unintended consequence of creating this blow-off top in credit that we had in 15, 16, and early 17, which led to the massive home price increases that we had during that time, especially in Vancouver and Toronto. Now, late 16, Vancouver detached topped out. Early 17, Toronto detached topped out. The Vancouver condo market topped out at pretty much the turn of the year. Toronto's looks like it's in the process of turning now. So that's where we stand there. And of course, the Bank of Canada has been on this rate hike path. As I mentioned in previous videos, it's all to overcompensate for their mistakes in 2015. So that's where we stand now. Now, as far as mortgage rates goes, as the 5 years had its ascent from really the middle of 2016, mortgage rates have gone up with it. Now, do you think rates are going to go demonstrably higher from here? Again, I don't think so. As the economy showed signs of slowing down, as the deleveraging, the housing bubble unwind has really gotten going here. If you look at the medium, long end of the Canadian Treasury curve, 5s, 10s, 20s, 30s, everyone thinks we're up. We're really at this almost the same place we were now as we were back in March. So things haven't really gone up. As the Bank of Canada has increased rates, the short end has gone higher with that, which has led to that flattening of the yield curve I've talked about on here, on Twitter, etc. Now, what's the end game here? The Bank of Canada, a 25 basis point rate hike in October is confirmed at this point. December looks like it's probably a go as well. As usual, central banks will hike too far. They'll create an inversion of that yield curve, where the 2-year yields more than the 10-year. The 5-year yields more than the 30-year. Go down the line on that. Which is always a leading indicator of recession, which then always leads a massive tightening of monetary conditions, which then ultimately leads into the recession. So that's now. What do I think is going to happen next year? The Bank of Canada is going to see what's going on. I know they want to follow the US or whatever, but I really don't think they're going to have that luxury, unfortunately. They're going to see what's going on. They're ultimately going to see, at some point, they're going to have to try something. Whether it's QE, rate cuts, again. But we'll go into it more then, of course, but they're going to see they're going to have to try something. Which then, of course, after the inversion, you're going to have the bear steepener happen, where the short end starts to come down as they start to price in future Bank of Canada action. So basically what happens there is, after the yield curve inverts, right before a recession, there's always a re-steepening. Why is that? It's that basically the long end stays the same or starts to go marginally lower, But the short end, to make up for possible central bank action, has to go much lower to make up for that. So basically what the market's saying at that point, on a steepening after an inversion, is that things are so bad, the central bank's going to have to step in here and try something. That's basically all that means, in layman's terms. But, as far as mortgage rates go, what I envision happening is, as the 5-year, the medium end, starts to work its way lower, mortgage rates are going to stay elevated, basically where they are now, maybe even a bit higher than where they are now. Let me explain this. As the housing market starts to roll over in 2019, as the losses start to mount from the big two markets and ultimately spread, what's then going to happen is banks, mortgage lenders, etc., to make up for those losses, are going to have to start pulling money back in an attempt to shore up their balance sheets. That money they're pulling back will take away from new credit creation. Basically what I'm saying is, to make up for the losses, they're going to disincentivize credit. They're going to pull their resources back, and they're going to keep mortgage rates elevated to further disincentivize credit. Basically what I'm saying is, starting in 2019, people that normally would get credit won't be able to get credit. Because financial conditions are going to have to tighten that much. The banks also as well, beyond rates, they're going to have to adjust their own internal requirements for credit scores, etc., for income, etc., to make up for what's coming in 2019. I know it was a lot. I'll go ahead and summarize the last part quick. In 2019, we're going to start seeing write-downs from all the banks, major lenders, etc. Money that would otherwise go to credit creation will have to get pulled back to make up for future losses. And that market will tighten even further. They're going to have to tighten their own internal requirements to ensure that they are tightening credit, to make sure the balance sheets are shored up, etc. And the real pain, I've said, is coming. This would be the year where it does come. That's all I'm going to say. Hit the like button, leave a comment down below, subscribe for more, and most importantly, follow me on Twitter at CryptoMarkets2 for this, everything else. You'll have a good